here and apologize for the congressional schedule deferring your appearance. Appreciate you staying here. And we'll begin our testimony of the third panel, with Mr. Andrews.
Mr. Minnick, thank you very much for the opportunity to come here today. I'm Steve Andrews, President and CEO of Bank of Alameda. It's a bank in San Francisco Bay Area, Oakland. I'm a state chartered bank operating in the state of California, roughly 250 million assets. I'm pleased to be here today to address the panels as well as the committees with respect to state of small business and real estate lending in local markets. I'm also very pleased to represent 5,000 community bank members for the Independent Community Bankers of America. Bank of Alameda is like most small banks. We specialize in small business lending, we specialize in real estate lending, we specialize in relationship lending. Community banks across the nation, some 8,000 community banks, staying ready and prepared to continue to lend into their communities and support those businesses that require stimulus and recovery. My bank faces serious challenges. We just heard from a series of regulators up here about their work trying to mitigate some of those challenges. But the facts remain that community banks are operating in the toughest economic climate and the most severe regulatory climate we've seen in over 2 decades. We've heard about the pendulum, and from community banks' perspective, that pendulum has moved too far into the category of overregulation at the expense of lending. And we see the results of that with many of your constituents coming into your offices and worrying about the allocation of credit. The regulators are questioning real estate values. They are making subjective calls on the street and in community banks, and that is creating an atmosphere where many banks are reticent to make viable commercial small business loans. While the economy has suffered, and certainly some of those CRE borrowers you see out there are having trouble financing and making their payments, regulatory burden has added another category and stress to the situation. We also have fairly healthy economies that exist in the United States. Even in those areas, community banks are suffering because regulatory constraints are asking them to reduce overexposure in the CRE area. The regulatory environment is tough. Some of our best clients in the Bay Area come into us and cite it's not only that, it's that we are concerned to invest today. So yes, there is an element of our borrowers that are concerned to invest and take out additional credit because they're not sure, as all of us here today are, when this recovery will take effect. I want to concentrate the balance of my remarks mostly with the regulatory environment. I do see, and believe me, I represent 130 bankers in California representing the CIB, California Community Bankers, Independent Community Bankers, and the ICBA, that banking regulators are making tough decisions in the field. This guidance is relatively new out in November, but anecdotally I am seeing that the regulators do have their feet on bankers' throat in some cases, as we heard from the first panel. In my Pacific example, regulators came into the bank, they raised our leverage ratio from the 5% statutory minimum to 10%. In that case, what happens is you have to adhere to those agreements, and it inhibits our ability to lend. Our bank has had to reduce its balance sheet. Loans outstanding at the end of 2007 were roughly 248 million. Today, they sit at 200 million. That's not a way to make the economy recover. Although my bank meets the higher 10% thresholds, it does come at a heavy toll. Field examiners, when they come out today, are getting mixed messages. They're hearing from Congress, they're exhorting the banks to lend. I think sometimes they're also hearing that they need to remain tough and make sure that they have a tough regulatory environment so we get through this rough patch. It's not an easy job, and I felt a little sorry at some point for the regulators who were in the room, but the reality is that they're making very tough on community banks to lend, and banks are reticent, especially when we have these high capitals imposed on us. Also, when we're asked to bring our loan loss reserves to exceedingly high thresholds, that impairs our ability to allocate capital into lending. In closing, I'd like to say that the Independent Community of Bankers fully endorses the $30 billion fund we've chatted about. We think that's a very prudent idea. At the same time, we also want to make sure that some of the stigmas attached to the TARP financing is not placed with this. I think Herb Allison, when he spoke correctly that there is reticence upon bankers to jump into a fund like this if there's going to be a lot of hooks into that. Bankers do not want to see the deal change after it's out. Thank you for your time.
Thank you, Mr. Andrews. Mr. Bridgeman?
Thank you. Ranking Member Backus, Ranking Member Graves, and members of the committee, it is an honor to be here today. I am sort of the poster child of SBA lending, of community banking, and also I'm a receiver of TARP funds, so I'm a rarity in community banking. Ladies and gentlemen, I have never been to Wall Street, but I have lived and I work on Main Street. I have never made a subprime loan. I can barely say derivatives, let alone put it on my books. We do not compete with loans at the local level with our too-big-to-fail banks. We do not. They do not come into our communities and ask for loans, but they do come into our communities and they ask for deposits. Currently, community banks make up 11% of the total financial network. We at community banks make 38% of the small business loans that fuel our economy. It's the small business loans and the small businesses that put 60% of the new jobs together for this country. You've asked the question as to why we are not lending to small businesses. There are two primary factors. First, small businesses have taken a pounding in the last 2 years. Their financial statements are in chaos, and they do have a tough time qualifying for credit under prudent policies and practices. Additionally, the businesses that do qualify are very concerned about their future and whether they should be lending or whether they should be going out and seeking credit or not. Small businesses are concerned about the economy, what's happening with health care and taxes. The other side of the problem is the regulatory burden, as has been mentioned here today several times. Regulators are taking a myopic view of every bank that they look at. When they look at a bank, they are looking at it as if it is an independent institution without regards to what's going on in the larger picture of the country and the economy. I would point out that the letter written by Congressman Frank, chairman of this committee, and also Congressman Minnick that I have here spells it out very, very clearly what your problems are. And I would tell you that every banker that read this letter stood up and applauded because it is dead on as to what the problems are from the regulatory point of view. There are two primary hindrances that are affecting what banks can do in lending. One is the higher capital ratios. They have arbitrarily and unofficially raised the capital ratios in this country with community banks to an 8% and a 10% minimum used to be is now 12%. With these excessive ratios, we are not able to lend. It hampers the ability of us to loan. Secondly, they have decided that reserves need to be raised to excessive levels, ratios that are therefore taking capital out of the ability to lend. They're also asking us to write off credit. They're making us take impairments that are excessive, and basically reducing portfolios is the result of that. I have had to shrink my bank even though I'm well capitalized. I've shrunk my bank in the loans, on the loan side, and we are working diligently to get our capital ratios, which are well capitalized by all regulatory standards. We are well reserved by all standards, and we are taking those up. Some comments that I've had in my recent examination from the examiners are, TARP funds are used for the purposes of increasing capital and increasing loan loss reserve. That is not the reason that TARP funds were ever created. They were there for lending. And we did loan. We created almost $20 million in new credit, and we were criticized by the regulators for growing our institution. We were criticized for having a concentration of owner-occupied credit, commercial credit. We were criticized for that. We were also criticized for having troubled debts restructured loans. Those loans, TDRs as they're referred to, are how we're helping our customers continue to operate and keep people employed. Some of the concerns I have are that that lending has ceased and that no jobs are going to be created right now. Our economy is struggling, and I will tell you my community is struggling as well. My concerns are also that if we continue running into the commercial real estate problems, we're going to have a second dip in the economy. And I will tell you that the regulators have a lot of control at this point with community banks in determining where the economy will go. In conclusion, I am a community contractor. I build communities, and that helps build our country.